785,000 ounces. That's how much silver is disappearing from COMEX vaults every single day. Not being traded, not changing price. Disappearing. Physically leaving the building. And at that rate, by February 27th, 15 days from now, the registered silver inventory that backs the largest precious metals futures exchange on Earth will be somewhere around 85 million ounces. That date matters. February 27th is first notice day for the March 2026 silver contract. It's the moment when holders of futures contracts declare their intention to take physical delivery. And sitting on the other side of that deadline is open interest, representing 429 million ounces of silver, against a vault that may hold less than 85 million. This is not a prediction about prices. This is arithmetic, and the arithmetic does not work. For 5 consecutive years, the global silver market has been running a structural deficit, more silver consumed than mined, every year. But that deficit was manageable as long as one assumption held, that futures contract holders would keep rolling their positions forward, never actually demanding the physical metal underneath the paper promise. That assumption started breaking in 2025. Total COMEX silver deliveries doubled, from 203 million ounces in 2024 to 474 million in 2025. Every month higher than the same month the year before. Not a spike, a systemic acceleration. Then, January 2026 happened. A month that is historically minor for deliveries produced 49.4 million ounces of physical silver changing hands. That's 7 times the January 2025 level. And February, right now, is running at a 98% delivery rate. 98% of open interest demanding metal. The futures market was designed so that most participants never take delivery. They use contracts to hedge prices, then close positions before expiration. That's how the system maintains liquidity with far less physical metal than the paper promises imply. When the delivery rate hits 98%, the system isn't functioning as a market anymore. It's functioning as a countdown. What I'm about to walk you through is the most important set of numbers in the precious metals world right now. Not opinions, not forecasts. The actual warehouse reports, delivery notices, and open interest data published by the CME Group, the organization that operates COMEX. By the time you finish this video, you'll understand exactly what March 2026 means, why the January crash didn't solve anything, and what happens when paper promises collide with physical limits. To understand why March matters, you need to understand how COMEX actually works, because the popular explanation is wrong. Most people think about futures trading as simple. Someone bets on the price going up, someone else bets it goes down, and money changes hands. That's the surface layer. The deeper layer is the delivery mechanism, and that mechanism is what's breaking. COMEX operates on a dual inventory system. Total silver in COMEX-approved warehouses sits near 411 million ounces. Sounds like plenty. But that total is split into 2 categories that function in completely different ways. Registered silver, currently around 103 million ounces, is metal that has been certified, warranted, and made available for delivery against futures contracts. It's the only silver that can be used to fulfill a delivery obligation. Eligible silver, the remaining 300 million or so, is silver that meets purity standards and sits in an approved vault, but whose owners have not authorized it for delivery. It's private metal, stored for safekeeping. The exchange cannot touch it. This distinction is the entire ballgame. When someone stands for delivery on a COMEX silver contract, the exchange doesn't reach into the total inventory pool. It reaches only into registered stock, and registered stock has been collapsing. In October 2025, registered silver sat at 167.7 million ounces. By early February 2026, it had fallen to 103 million, a 38% decline in 4 months. Since 2020, the decline is approximately 75%. Now, here's the mechanism most analysts refuse to discuss publicly. When a delivery occurs on COMEX, the physical silver typically doesn't move. What changes hands is a warehouse receipt, a warrant that represents ownership of specific bars in a specific vault. That warrant can change hands multiple times without a single ounce leaving the building. This is how some commentators dismiss rising delivery numbers. They say it's just paper shuffling. And for normal periods, they'd be partly right. But what we're seeing in 2026 isn't normal warrant circulation. The metal is physically leaving the vaults. Withdrawal data confirms it. The distinction between ownership transfer and physical removal is critical, and both are accelerating simultaneously. If you're beginning to see why this matters, not just for silver investors, but for anyone who trusts that financial markets are backed by something real, hit subscribe. What comes next is the part where the numbers get truly uncomfortable. Because the January crash was supposed to fix this. It didn't. It may have made it worse. On January 30th, silver crashed 31% in a single session, the worst day since 1980. The mainstream narrative was clear. Speculative excess had been purged. Chinese retail investors who had driven prices to $121 through leveraged vehicles like the UBS SDIC fund had been flushed out. Margin requirements were raised. Positions were liquidated. Order was restored. That narrative is mechanically accurate for describing one trading session. It is dangerously misleading for understanding what comes next. The crash purged leveraged speculators. It did not create a single ounce of new silver. It did not reverse China's January 1st export restrictions. Restrictions that reclassified silver as a strategic material granted export licenses to only 44 approved firms and required minimum annual production of 80 tons and credit lines above $30 million to qualify. China controls 60 to 70% of the world's refined silver supply. That choke point didn't disappear because prices fell. The crash did not slow industrial demand. Solar panel manufacturers, electric vehicle producers, semiconductor fabricators, and AI data center builders don't stop purchasing silver because the spot price dropped from 121 to 82. Their demand is structurally embedded in production lines that take years to redesign. Samsung's trading arm didn't negotiate a $7 million prepayment deal with Silver Storm Mining to restart a Mexican silver mine because they expected prices to fall. They did it because they couldn't secure reliable supply through normal market channels. The contract gave Samsung exclusive rights to 100% of the mine on silver-lead concentrate output for 2 years. That's not market procurement. That's resource lockup, the kind of move companies make when they believe the exchange-based supply system is failing. And the crash did not change the COMEX delivery calendar. March remains the primary delivery month. First notice day remains February 27th. The open interest in March contracts still represents between 425 and 528 million ounces of notional delivery obligations, depending on which week's data you reference. Even at the conservative end, that's 4 times the registered inventory. Even using historical delivery percentages of 10 to 20%, March faces delivery requests of 42 to 105 million ounces. At the upper end, that's more than the entire registered stockpile. Here's the detail that should concern you most. In early January, before the crash, analysts at FX Street documented something extraordinary. March silver futures contracts were being rolled backward to January and February. Traders with March positions were paying to accelerate delivery, to get physical silver sooner rather than later. On January 7th alone, the net movement suggested approximately 1.75 million ounces of silver longs who couldn't wait until March. When participants in a futures market start paying premiums to get metal earlier rather than later, the signal is unambiguous. They don't trust that March delivery will be honored normally. So let me lay out the full picture as it stands today. COMEX registered silver inventory, approximately 103 million ounces and draining at 785,000 ounces per day. At that rate, by first notice day, on the February 27th, the number drops to roughly 85 million. March, open interest, 429 million ounces at minimum. February delivery rate, 98%, nearly every contract standing for physical metal. January deliveries, 49.4 million ounces, a 7-fold increase over January 2025. Silver lease rate, 8%, versus a historical norm of 0.3 to 0.5. Annual global supply deficit, over 200 million ounces for the 5th consecutive year. China's export control, effective, covering 60 to 70% of global refined supply. Total 2025 COMEX deliveries, 474 million ounces, more than double 2024. Each of those numbers tells a story on its own. Together, they describe a system approaching a boundary it was never designed to cross. Now, a necessary note of intellectual honesty. Not everyone agrees this leads to default. The counter-argument, articulated most clearly by analysts at Gold Silver, is that open interest doesn't equal delivery demand. Historically, the vast majority of contracts are rolled or cash settled before expiration. A COMEX delivery is not always a physical removal. It can be a warrant transfer where metal stays in the vault. And the 98% February delivery rate may be overstated by using a single snapshot of open interest as the denominator, when open interest is dynamic and constantly changing. These are fair points. Markets have mechanisms for managing stress, margin increases, position limits, cash settlement provisions. The question isn't whether these mechanisms exist. The question is whether they can absorb the scale of what's approaching, given that every structural parameter, inventory, delivery rates, lease rates, supply deficits, export restrictions, is simultaneously at extremes that have no historical parallel. December 2025 delivered 46.6 million ounces. That was 50% of the estimated free float registered inventory. If March matches December, the math is tight. If March exceeds December, which the trajectory suggests it will, the math breaks. And if the math breaks, the resolution comes in one of 3 forms: a sudden spike in price sufficient to destroy enough demand to rebalance a shift to forced cash settlement that shatters confidence in COMEX as a physical delivery mechanism or regulatory intervention that rewrites the rules mid-game. None of those outcomes are quiet. I want to hear your read on this. Which scenario do you think plays out first? The comments on this channel consistently surface analysis that institutional reports miss, so tell me what you see. Step back from the numbers for a moment and consider what they represent. For decades, the global silver price was determined not by the physical metal changing hands between miners and manufacturers, but by paper contracts trading on exchanges in New York and London. At the peak, the ratio of paper silver to physical silver reached 356 to 1. 356 ounces promised for every 1 ounce that actually existed in deliverable form. The system worked beautifully, efficiently, and profitably. As long as one condition held, almost nobody asked for the actual metal. 2026 is the year that condition failed. Not because of a Reddit movement or a viral social media campaign, though those played a role at the margins. It failed because of something far more structural. China reclassified silver as a strategic material and restricted its export. Industrial consumers, from Samsung to solar manufacturers across Asia, started bypassing exchanges entirely, locking up mine output through direct prepayment deals. Central banks in emerging markets began accumulating silver as both a monetary reserve and a strategic industrial input. And the physical market, squeezed from every direction simultaneously, started demanding what the paper market had always promised but never expected to deliver. The lease rate tells the story most clearly. When institutions are willing to pay 8% annually just to borrow silver for short-term delivery, compared to a historical norm under 0.5%, they're sending a message that cuts through every analyst's opinion and every price prediction model. The metal isn't where it's supposed to be. The vaults are lighter than the warrants suggest, and the people closest to the physical market know it. What's within your understanding now is something most market participants still don't grasp: the distinction between a price and a delivery mechanism. Silver's price can be moved by margin hikes, liquidation cascades, and dollar strength. And we watched exactly that happen on January 30th. But silver's delivery infrastructure operates on physics, not sentiment. Either the metal is in the vault, or it isn't. Either the warrant is backed by unencumbered bars, or it isn't. Either March delivery can be fulfilled, or it can't. No amount of paper trading changes those binary facts. Remember where we started: 785,000 ounces per day, draining from registered inventory. 15 days until first notice day. 429 million ounces of open interest against a vault that's shrinking toward 85 million. These numbers will resolve themselves one way or another before March is over. The resolution will be visible in warehouse reports, in delivery notices, in lease rates, and ultimately in price. The data is published daily by the CME Group. You don't need an analyst to interpret it for you. You just need to know where to look. Now you do. The countdown isn't a metaphor, it's a calendar date, and the vaults don't negotiate,